Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, June 18th, 2025. Today's episode begins with our main headline, Initial/continued jobless claims remain elevated. That came out today a day earlier than normal because of the holiday tomorrow. While the initial claims came out with nothing really to panic about, I am going to say that for 3 weeks in a row now, we've been over 240,000 claims, seen only one other time back in June of 2023, within the last 2.5 years. And while unemployment as a percent remains at 4.2%, the continued claims is also at 2.5-year highs, ticking down very marginally from the last report of 1.951 million continued claims to 1.945. Certainly a whiff of smoke, but not enough to claim there's a fire. Next headline, the FOMC released today no change in the Fed funds target rate, and some notable quotes from Chair Jerome Powell from the conference afterwards. I just want to quote and talk about him a little bit. One is one that he's repeated at every meeting, these two right here, and I'm just going to bring them up again because I think it's an important piece of what's going on here. He said, "Our obligation is to keep longer-term inflation expectations well anchored." In other words, that's the break-even inflation rate. That is the 10-year break-even inflation rate. That's what he's talking about, by the way. And to prevent a one-time increase of the price level to becoming an ongoing inflation problem. And then this is the real kicker that I think a lot of other people that talk and write about markets are not taking into full consideration and he says over and over again in every conference, without price stability, we cannot achieve the long periods of strong labor market conditions. While others are expecting him to cut, to stabilize the job market if things start to deteriorate a little bit, this statement makes me believe otherwise. I think that the hawkishness is going to go on longer than most other people think. So if we get to this point where in September, for example, where we're priced to have that first cut, if we get there and inflation is still high and the job market is showing a little bit of cracks, I don't think that's going to be enough of a reason to cut. And I think that might even surprise markets if it ends up playing out that way. More likely than that, at least with my own crystal ball and all, I think initial claims week after week are going to start to show more and more cracks going into the July meeting. But we'll get there when we get there. One other quote from in the question and answer part of the meeting that I found notable was he said, "No one holds these rate paths with a lot of conviction." I just find it so funny because so many people rely on the Fed's sentiment and guidance as to what they think about markets, what they think about inflation expectations and the labor market. And he says specifically right here, we are giving, this guidance, but no one holds them with a lot of conviction. And if you read the statement coming out, there's a long part about how much uncertainty there is. And he even said in the meeting too that we have elevated levels of uncertainty, all about uncertainty. In other words, this is what we think, but we really have no idea. He's trying to make everybody understand that, that point very clearly, that they don't know. They just don't know. They can only react to the incoming data. That's all they can do. As much as you have different players wanting them to do different things for different reasons, that's their job. And that's just, it's and it's largely, from my perspective, sort of an unnecessary evil. It has to exist. It has to happen this way. It's the best way that we know how to make things work, and so the world keeps turning. Anyway, the third headline today I wanted to bring up, I put this on X. If you don't follow me, my handle is in the description. I'm not very active on there, but I wanted to share it on the show because I think it's important. Specifically, the M2 money supply ratio to gold. So how much can gold cover all the M2 money supply, all the dollars that exist? A commenter on a video a while ago mentioned this, how they thought that this is bullish for gold, and okay, you could interpret it that way, but just to quickly explain, when this line is low, obviously this was when gold had hit a major peak in 1980 and had not gotten that high for decades after. So when it's low, that's when gold is very expensive compared to the M2 money supply. And when gold is extremely cheap compared to the M2 money supply, it's way up here. And where are we today? I just find it notable that, as far as trend line goes, you can't help notice these things when you are looking at charts and trying to figure out where psychological levels might exist for various things. If you connect the 1980 peak in gold to M2 money supply, and you connect it to the 2011 peak in gold, that line connects to almost exactly where we are today. And so I think that might be preventing gold from going higher at least a little bit. And from this chart, I gotta say, a normal-ish range might be around a ratio of around 9 or 10, and right now we're around 7. So I compare the price of gold often to housing, copper, and crude oil, and talking about how enormously overvalued gold is compared to these three things. And historically speaking, it's not too far away from what we might consider to be normal from the M2 money supply to gold ratio, but it's elevated. Gold is still, even related to the M2 money supply, it's still sort of expensive compared to what we see throughout history. Can it get more expensive? Well, yeah, but am I going to bet money on that? As a value investor looking to buy things that are cheap and hope that they go up to a normal value, which is the way I play this game, it's not the game that I'm going to be playing. But remember, I'm just a guy with a crystal ball. For me, I'd rather play sort of the opposite side just within the metals markets. REMX is 5 to 6% of my portfolio, which is lithium miners and rare earth miner companies. All the other metals are lagging way behind gold. So if gold keeps going up, then I would think that the other metals would also rise, but other metals can also rise if gold goes down, Anyway, I digress. Next, community topics. What moves, if any, did you make today? Comment in the comment section below. I'm really curious what you guys are doing. You can share with each other what moves you're making. I actually bought some more MSOX. This is just like tiny bit of money. It's a leveraged form of the cannabis industry. I don't think there could possibly be more fear. I cannot imagine. I don't think this industry is going to zero. It's a multi-billion-dollar revenue industry now. I don't think it's going away. It may consolidate. You will have companies eating other companies, and it's good for both of them. When a bigger company acquires a smaller company, the smaller company gains all its value, and the bigger company gains value too in those situations. I think we're headed there, and if you own the entire index and get some leverage on it, I'm willing to gamble a little bit on that. So that's what I did today. Tell me what you did in the comment section below. Coming up tomorrow, of course, markets are closed for Juneteenth holiday. And then Friday, we have another, we had the New York manufacturing data come out. I think it was Monday this week. We have that for Philadelphia coming out on Friday, which could be very interesting, especially if it's as weak as the New York data. We also have the U.S. leading economic indicators, one that I am keeping a very close eye on. This is one of those things that, this has been absolutely collapsing. So I'm looking forward to that report greatly. Also, continuous tariff updates. I know there's stuff going on in Iran, LA, Minnesota. There's all this crazy stuff going on. Don't forget about the tariffs. The unpause button comes pretty soon, early July. Also, federal budget updates still incoming that can really affect markets, as well as the Iran-Israel conflict. Will we have a oil shock or not? Or will we have elevated oil prices, all through the summer because of this? That will impact markets to a large degree. So this is an important thing to be keeping an eye on for sure. Thank you, as always, for watching, subscribing, commenting, and supporting. I am almost at that 1,000 subscriber mark. Thank you so much for your subscription. It really helps me out. If you haven't subscribed yet, the button's right over here in the corner of the screen. You put your mouse over it, and then it says subscribe, and you just click on it right there. Thank you so much. No changes to the daily reminders macro view. See my website in the description to read them. No changes to the crystal ball readings nor the Robschild portfolio. Just added a little bit more MSOX. Holy moly, what a boring day in markets. The S&P 500 SPX closing negative 0.03%. Powell and the gang succeeded in just keeping the hand steady. No panic, no fear, nothing to see here. And Mr. Market agreed. CNN's Fear and Greed Index agree, staying in neutral for the second day in a row. TLT, my favorite place to be. Intraday, finding a bit of volatility, first spiking to the upside on the FOMC news before selling down, and then closing actually just a bit higher than yesterday's close, up 0.17%. Still inside this blue channel. High yield credit spreads or junk bond credit spreads also tightening marginally today, as expressed through HYG divided by Chi. Just to remind everybody, they're elevated here. It's tight. The junk bond credit spreads is pretty close to 3%. This is fairly low. This is pricing in no volatility. This is everything is perfectly peachy. Everything is definitely going to be fine. Oftentimes this is a complacent signal when it's this tight and staying this tight, along with the stock market, Cape-Shiller ratio still being at 38. Again, see my website for the whole thing. I don't want to read through my whole rant of how unbelievably overvalued I think stocks are right now. This is supposed to be a day-to-day show, but on a day-to-day show, yeah. So just nothing to see here across all markets. I want to add that HYG specifically has an effective duration of 3 years. So, and with the spread being 3%, it means people are saying, okay, this debt will most definitely get paid back. It's called a junk bond. It's called a junk bond, just to remind you. And they're accepting 3% higher than a treasury rate for these junk bonds. That's complacent to me. I don't think that's a good investment at this level. But I'm just a guy with a crystal ball. The dollar index also didn't really move today. Lots of people were wondering, hey, is the dollar about to collapse? There still are plenty of bears on the dollar that think the dollar is going to fall strongly from here. I'm not one of those people. I think the weakness in jobs, manufacturing data, along with consumer sentiment. I think there's going to be a rush to dollars. I think there's a higher chance of that than the dollar dropping. Again, just a crystal ball reading. And the last chart of the day, the 10-year break-even inflation rate. Like I said earlier in the show, the Fed did its job 100% the way that they wanted to. They affected markets. Oh, you can't see it. Oh, here we go. Now you can see it. Depends on the scroll view. So from day to day, from yesterday to today, the break-even inflation rate remained exactly the same, not budging, not 1 inch, staying at an expected inflation rate of 2.31%. This chart is what the Fed is trying to control. They do not want it going up and up and up. They also don't want it going down and down and down, as it was in September of 2024 when they started cutting very aggressively with a 100 basis point cut. Since then, we've been staying above that 2% level. I'm not sure how long we're going to stay above that level, considering the fact that we have been seeing lower lows, lower highs, lower lows, lower highs. I think we're going to see another lower low in the very near future. But what do I know? I'm just the guy with the crystal ball. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.